My name's Mike. I'm the Managing Director of MCG Quantity Surveyors. I have a Bachelor of Construction Management and I'm a tax nerd, depreciation specialist and a registered tax agent as well. So MCG, that's my business. We started in 2011. We're the fastest growing quantity surveyor in Australia, and we've been fortunate enough to win the Client Choice Awards in the last 2 years as well. So what have you got yourself in for today? Firstly, thank you for coming, because there's a few different options at 12 o'clock. It's a contested time slot, but hopefully we've got enough value to make it worthwhile for you today. We're going to talk about depreciation legislation changes, what's happened in the space in the last little while. We're going to talk about construction costs, because as I'm sure you are aware, construction costs have really been accelerating in the last little while, so we'll look at the future for that. We're going to talk about some industry first data on property investor behaviour, so you can see what people are buying and where. We're also going to talk about missed deductions. This is a topic that really keeps me up at nights. There was $2.88 billion worth of missed deductions floating in the ether. We broke this story in news.com.au a couple of years ago. That figure has come down, thankfully, but there's still some significant deductions missed out there. We're also going to talk about key mistakes that property investors, accountants, and even quantity surveyors are making when it comes to tax depreciation as well. So what's changed in the latest legislation, TR 2022/1? The short story is not a tremendous amount. We've got some new industry categories. We've got casino operators in there. So thankfully, Mr. Packer's going to get a couple of extra deductions. I'm sure he really needs them. But there hasn't really been any major depreciation changes in residential or commercial since 2007, when we had the budget change for plant and equipment changes for residential property. 2019, we saw some new plant and equipment categories like water tanks and those sorts of things, but it's been pretty stable. Interestingly, there's a new category that I think is born out of COVID. It is the sneeze guards with a 2-year effective life. Unfortunate sounding ATO category. My previous favourite was digital peepholes, which came out a few years ago. And I just love the idea of the ATO sitting around a table saying the word digital peepholes. They're talking about intercoms. I just don't know why they didn't call it that. Now, construction costs, as you will no doubt be aware, have risen quite rapidly in the last couple of years. We've seen major problems to supply chains. So obviously the COVID situation made supply chain disruption a huge problem in the construction industry. And a big percentage of our materials actually come from China. The war in Ukraine is a big one as well for supply chain issues. We had the home builder grant that came out that created quite a lot of demand. We've got a bit of a labour shortage as well. We haven't had the international migration to fill a lot of those positions. And we've also had a lot of natural disasters. So all of these factors have conspired together to see a really rapid rise in construction costs. Here's a little bit of a slide that shows a bit of a breakdown about which parts of a building have seen the biggest increases. Timber was probably the first one that we noticed. We've seen some really rapid increases in timber prices. Steel is one of the bigger increases in prices. And since this data was released, concrete has actually been rising quite a bit as well. So we were talking very big numbers for increases. The prices are still going up. The Australian Institute of Quantity Surveyors is predicting a 4.3% increase to September this year. And you can see on the slide here, we've got the difference between inflation and the building price indices as well. So you can see that rapid increase in construction costs, and that's causing a lot of problems for builders. We've obviously seen unprecedented liquidations in the space last year, and even as recent as yesterday, builders are going bankrupt. So residential construction costs increased by 11% to the 12 months to September, and that's on top of the 10% to June the previous year as well. So that's a really rapid pace of change. It's the biggest change that I've seen in construction costs since I've been around, and I am quite old. The good news is, though, the pace of change is slowing. A lot of people will ask me, are construction costs going to go back to what they were? I mean, the short answer is no. construction costs are unlikely to go back by virtue of the fact that many of these builders had fixed price contracts for a certain price where their margin might have been significantly less than the rise of construction costs over that period. That's why we saw so many liquidations. So builders will be looking to recoup that margin as best they can. Let's talk about investors though and investor behaviour. What have we noticed in the space? Well, we know that investors are buying much less new property. That actually peaked at 49.5% of property investors that come through our business MCG quantity surveys were buying a brand new property. Now that's actually crashed back down to 16.24% and is it now in this financial year at 29%. So new property, even though you're getting better deductions with the plant and equipment items, still being able to claim them, I think the proof in the pudding of capital growth is more in the established space than in the new property. What are people buying? Houses, units, townhouses. Townhouses have been really, really popular. They still represent quite a small percentage of total purchases, but it's growing very rapidly. But houses are still number one for investors at 64%. Units have suffered quite a lot. There's been a bit of publicity around units in the last couple of years with cladding issues, construction issues, defects. You know, people being evicted on Christmas Eve is not good for publicity for units. It has really suffered. And at the beginning of the pandemic, we saw some really, really high vacancy rates, around 11% in Melbourne CBD. Of course, that's come back now. We're in a really tight market, but that's kind of scared investors off units. How much are people paying? Well, there's been a 24% increase over the last 6 years on the average amount of money that they're spending on a property. The average house price, we're talking $675,000. Units typically will be a little bit less than houses. In this data sample, we looked at 1,000 residential reports that investors brought through to us. We actually had a couple of really high value units. One was over $9 million as an individual purchase, so that's kind of blown that out. The team wanted to sort of smooth the data. I'm like, no, the data is data. We tell the story, and it is a little bit more common for investors to buy, a prestige unit and rent it out than it is a prestige house and rent it out. And townhouses, just over $500,000 as an average purchase. Now, where are they buying? We've been analysing this data for quite some time, and Queensland has been the most popular location for investors to purchase in over the last couple of years. I think if you compare the Melbourne COVID situation to New South Wales to Queensland fared a lot better. And it's also an affordability question as well. There's a lot more that you can get for your money in Queensland, southeast Queensland. The property market in Brisbane went gangbusters. The median house price was in the sevens before that happened. And there's still more value in property for investors. And as you see, most investors aren't spending $1 million on an investment property. It's at $670,000 or thereabouts. So that's why Queensland's popular. Victoria has suffered in terms of popularity for investors, and WA has been on the up and up. We don't do a huge amount of work in WA. We've got an office there. We've just got some new staff there because we're seeing a huge demand over there, and a lot of that is fed by the property price point as well. People are spending a lot more on renovations. So when people come to us to get a tax depreciation schedule, we ask a lot of questions. Many of the questions are the reason why we have this data, and it doesn't exist anywhere else, and we're really proud about that. But what we do ask them is, have they made any improvements to the property since they purchased the property? Of course, we're looking at prior works as well. But the average purchase, the average spend on renovations is up to $37,000, which is 26% up in 12 months. Now, I think what happened during the pandemic, we didn't know exactly what was going to happen. So people built a war chest. The household savings ratio really went through the roof. Then we kind of sat at home because we couldn't go anywhere else. We looked at the house and thought, this is a bit rubbish, isn't it? Let's spend some money on it. And, it took us a while to be able to spend money going out for dinner or going on holidays. As it turns out, we tended to look at our spouse as well, and divorce rates went up during the pandemic. But ukulele sales went up 700% during the pandemic. So I think that's actually probably more a contributor to divorce rates, but we'll see what the ABS has to say about that. Now, how far do property investors buy from where they live? It's become a bit of an old adage that property investors aren't terribly clever and they like to buy around the corner from where they live because they feel comfortable, they know the local area and the local market. So we actually broke this data on news.com.au in 2019, and we saw that the average was 293 kilometres from where the investor lives to where they bought their investment property. Now, when we analysed that data during the pandemic, it catapulted to 559 kilometres. And I think the difference is probably that, you know, at 293 as an average, a lot of those would probably be inspected by the investor, but over 500, it's likely that many of these would be bought sight unseen. That number, which we've just crunched, is 857 kilometres. Now, Australia is pretty wide. If you go from the east coast to the west coast, we're talking 3,500 kilometres or what have you. So there's still plenty of room. But to me, that really smashes that idea that property investors only buy around the corner from where we live. And I think it also speaks to the rise of buyers agents that are finding these hotspots and these investment areas for, you know, property investors to buy around the country. They're certainly becoming quite popular. Now, missed deductions, I mentioned this keeps me up at night. What we actually did the first time we looked at this missed deductions issue is we looked at 1,000 residential transactions. So 1,000 depreciation schedules we did for clients on residential property. And we found that 6.7% of property investors waited so long, i.e. more than the 2 years you can back claim. They waited more than that 2 years to get in touch with us. Now, the average figure that an investor lost by waiting too long was $20,537. I don't think it's written on the slide, and I don't need it to be because it's burnt into my mind, because it's a horrifying amount of money. You know, that could be $7,000 or $8,000 gone from an investor's pocket. So what we did is we looked at the total investor population, we applied that 6.7%, we applied the $20,000 of missed deductions, and that came to a magic figure of $2.88 billion worth of tax depreciation deductions just floating out there in the ether. And that's something that we've really tried to work on and try and educate investors about their entitlements. So I think the education is working. Certainly we try very hard in that space, and we know that accountants try very hard in that space as well to educate people. Some investors still don't have an accountant looking after their tax affairs. Whenever we hear that somebody is managing their own tax and they're an investor, we strongly encourage them not to do that because of the value that an accountant can bring in a million different facets. But it took 691 days, 6 years ago, from the date of property investment purchase to get in touch with us. So this is our data. And this year it's actually 184 days, which is a lovely amount because people might not necessarily buy a property in June and contact us straight away. They might buy it in July. So it's kind of like halfway between the 365 days. So people are getting much more educated to it. And when it comes to missed deductions, it's dropped from 6.7% of people to 4.53%. And the missed deduction amount is now $7,000. So that's still just under 5% of people missing out on their entitlements, and we want to go after that. We want people to claim their entitlements, but we're talking from $2.88 billion to 722. So it's a very, very different atmosphere or ecosystem now. So what are the average deductions? In our first analysis, where we were looking around about the $9,000 mark, it's hovered around that for the last couple of years. So $8,938 is the average depreciation in the diminishing method for residential property in the first full year of claim. And over the lifetime of the property, it's just over $216,000 worth of deductions. And you can see the difference between houses, units and townhouses there as well. If you come and visit us at our stand, which is over on the other side, we can give you a copy of this data as well. There's a giant bottle of champagne that you can go in the draw to win. So we'll buzz through that because I want to share some more info. Here's a bit of a case study. Now, People in my position love to show a case study where it's getting, $50,000 worth of depreciation deductions. I wanted to share something that we see every day. This is a more modest property. It's a typical property. This is purchased in Queensland. The first full year claim, $3,000, $54,000 worth of deductions over the life of the property. When you're paying $600 for a report that's tax deductible, depending on the marginal rate, depends what they get back. But if they're renting it out for at least 6 or 12 months, there's going to be value in it. So we see these types of properties all the time. I've lost my clicker. We might go to the next slide if we can. Oh, here we go. So this is a new property. This is in Tasmania. So the first full year claim, just over $10,500 and total deductions at $214. And that's a fairly modest standard of finish, that property as well. The next one, I'm just trying to figure out where I've got to wave this thing. The next one I want to talk about is the commercial property. So it's a fairly common property that we see, and commercial property has become much more attractive to investors. There are now lots of commercial buyers agents. There are commercial property investing podcasts. So we're seeing a lot more of these types of properties purchased. So this is a warehouse built prior to the cut-off date for the original structure or Division 43 deductions. It's had some renovations by the previous owner, 180 grand worth, and some bits and bobs done by the client, fairly modest, but still $10,000 worth of deductions in the first year. So these are some of the typical things that we see day in, day out. So I think education is working because of the reduction in the time it takes to order a report. And what we've actually found is that 15% of property investors contact us before their property even settles. Now that's not a number that we've actually reported on before because it was such a minuscule amount. People might buy a property and they get excited and they want to organise their depreciation schedule, but 15% is a big number to us. So that's getting in touch with us before even the settlement has gone through. So we see that number increasing, and we've actually seen the rise of buyers agents, residential and commercial buyers agents, really influencing those numbers because the buyers agents are the closest to that transaction a lot of the time. So they're recommending depreciation. I suppose it's a way that they can claim back some of their fee if they're charging $10,000 or $15,000 to the client and we can get some deductions back. That sort of helps to justify it. I think it's a little bit of a concern, to be honest, because the expertise of accountants is far and above these buyer's agents. The barriers to entry to become a buyer's agent aren't very big. And yes, you can have buyer's agents that are specialists in property and finding the right properties, doing the due diligence, finding the growth areas, making sure they've got the right yield and checking the demographics, but they don't have the expertise the accountants have. So we're always trying to encourage accountants that if you are working with clients in the property space and they're working with buyers agents, to try and be part of that conversation, because the advice that you can give is critical. And how many times do people come to you and say, oh, I bought this property, and you think, gosh, I wish you'd asked me at least the structure to put on the contract, right? So that is a little bit of a concern for us. I want to sort of try and finish on a little bit of a positive note, is where you guys can make a difference. And, I congratulate you accountants for all the work that you've done during the pandemic. That was a very difficult time, and a time where you guys had to be accountants and counsellors. But I think that there are ways that investors are getting things wrong that accountants can help with. Being part of the journey, working with buyers agents, I think is a good opportunity for accountants. We're seeing property investors really see the value in maximising their deductions, but not necessarily protecting their assets. So that's where I wanted to have a quick chat about insurance and underinsurance more specifically. So around 83% of property owners, both residential and commercial, actually aren't adequately insured. So what I mean by that is if the worst was to happen to their property, the cost to rebuild that property would be higher than that insurance amount. And there's all sorts of clauses, such as a co-insurance clause, where if you're if you're under-insuring a property, then you might have it insured for $1 million, but if you were 20% under-insured, they're only going to give you $800,000. So these are things that I think property investors aren't necessarily sure about. And they go all to this effort to build this portfolio, but aren't necessarily protecting it. So we see it as a real passion project for us. We've been doing replacement cost estimates as construction cost experts. So I would encourage you to have that conversation with your clients as well. And the numbers haven't really changed. Underinsurance has always been an issue in Australia, and we actually do find that there's 23% of Australian homes that are actually have no insurance whatsoever, and much of that would be mortgage-backed properties, right? How many of you get that annual reminder to send a copy of your insurance to the bank if you have a mortgage on a property? I have properties where they hound you every year. Others, they just make sure you have it in day one and then never again. And these policies are often lapsing. And given that Mother Nature has become very upset at what we've been doing to her over the last little while, I don't want to start a climate change argument, but certainly the East Coast lows, the floods, the environment that we're in is quite nasty. So we want to make sure that people are protecting their assets. There's a lot to go over today, so I just wanted to have a couple of things where we're finding people are getting their advice a little bit wrong. A lot of people are advising each other, clients, that sort of thing, that new property is not affected by the May 17 changes. So that was when Scott Morrison ruined a very lovely glass of Shiraz I was having at home and took away all the plant and equipment items for anything other than a brand new property or items that you put in yourself in a residential property. A lot of people are giving advice saying, well, if you buy a brand new property, you're not affected by that legislation. But it does actually affect all legislation, all property. And what I'm getting at there is if you buy a brand new property, but then you decide to occupy it at any point in time, you will actually kill off those Division 40 plant and equipment deductions from then on in. That's a key problem for things like holiday homes, where people are buying a brand new holiday home and they might go and stay there for a month and they fit it out brand new with all the furniture. They will kill off the deductions from that point onward. So that's something that we wanted to raise today. So yeah, incidental use I was talking about with holiday homes there. Repairs and maintenance is one of those perennial issues that the tax office says that they're coming after each year. And investors are kind of wise up to the fact that a repairs and maintenance expense is an immediate deduction, so they're wanting to shove as much as they can into that bucket. But the ATO are flagging year after year that this is something that they're looking at. What we actually have at our stand on the other side, which I'd love you to come and visit and say hello, we have a tax time checklist, which is great for your clients. It also has a guide to figuring out what is a repairs and maintenance asset and what is something that would need to be depreciated as well. So it's something that the ATO are always cracking down on. So come by our stand and we'll give you a copy of that. We've got hard copy and electronic copy as well. In terms of pre-purchase plant and equipment items, there's a bit of confusion if somebody renovates a property to a high standard and then they sell it straight away, they should be able to claim the plant and equipment items. Now, I think they should be able to claim the plant and equipment items, but according to the tax office, that unless you held the property as at the time that it was an investment, when it was first used, then you're not going to be able to claim those plant and equipment items, unless it's trading stock that you've bought, say, from a developer with a tenant in place. But there's a 6-month rule on that as well. So we'll talk about good news. The good news is that since the May 2017 change, which was the biggest change to the depreciation space, we're still finding that the vast majority of depreciation schedules are worthwhile for property investors. So we won't actually do a report unless we know it's got a clear benefit to the owner. We do all the homework for you guys, accountants, property investors, whoever it is. You can send through a copy of the realestate.com listing and we'll give you a free idea on the potential deductions. And if we can't make it stack, we're not going to recommend it to the client. We want to make sure that there's a clear benefit to them before we're proceeding. We think it's a good selling point for accountants. I work with some accountants that, as part of their sort of due diligence first meeting with a client, they'll often ask the question about depreciation, ping me a message, and I might say, look, this one that hasn't had anything done will get $3,000 to $4,000 in the first year, and straight away that's a differentiator between the accountant they were working with before. And we're here to help, and service is really our priority. So when we're plugging into another business, whether you like it or not, it can reflect upon you. So we've won the Client Choice Awards in the last 2 years running for AFR. So we're really proud of that. My mother told me not to brag, I should be more modest, but we are really proud of the work that we're doing in the space. In terms of how we can help, the first step, as I mentioned, it's just assessing whether a report is worthwhile. And we're offering a reduced fee on our standard residential fee for anyone that comes to visit us today. So we normally charge $650 plus GST as a flat fee on all residential across the country, it'll be $600 plus GST today, with commercial being a case-by-case basis. So please come and visit our stand. It's A32. It's completely on the other side over there, but it's not too far to walk away. We've got a giant bottle of champagne that you can go in the draw to win. You can get a copy of these slides and that repairs and maintenance schedule as well. So thank you very much. I hope that was enjoyable for you and you enjoyed the data, and I really appreciate you coming to say hello to me today. Thank you.
Follow us on our social media pages. You can find us on Facebook, MCG Quantity Surveyors Tax Depreciation Experts, on Instagram, at MCG Quantity Surveyors, and on LinkedIn, MCG Quantity Surveyors. Subscribe to our YouTube channel for more informative videos answering the real estate industry's frequently asked question and other fun content. Don't forget to like and share this video.